So today the Canadian Central Bank met and they raised interest rates 0.25% to a rate of 5%. And this is their second rate hike since they paused a few months back. And so one interesting thing is it's very uncommon for a central bank to start raising rates again after they pause. Once they pause, they're normally done until the next rate hiking cycle. So one of the things they noted when resuming hiking rates was that the housing market was starting to get carried away again, and they wanted to raise interest rates to slow the housing market a little bit. Now, in my opinion, this interest rate hike really puts the nail in the coffin for the Canadian housing market. But to be honest, whether they stopped at 4.75 or they keep going to 5.25, interest rates are still just generally high, and it's going to be bearish for the Canadian housing market and the Canadian economy as long as interest rates high, stay high like this. Now that is because this has been the fastest rate hiking cycle in the history of rate hiking cycles, which is just crazy to imagine. In the past, we've had rate hiking cycles, but in general, they have been a lot slower. This one has been very high. We've hiked 5% basically, and this has been all over the course of less than a year. So let's have a look at what this looks like. This here is the Canadian one-year government bond yield, and you can see that we are at super high levels right now. We haven't been this high since the 1990s, late 1990s. We're higher than we were during 2007, and you can also see we've gone from such a low level to such a high level so quickly. So this is guaranteed to have some effects on the Canadian housing market and the Canadian economy. Now, what makes this picture even scarier is when you see how high the debt is in Canada. So let's have a look at this here. This is the Canadian household debt to GDP. And the higher this is basically means the more debt we have. So we have a debt equal to 100% of GDP. Now that probably doesn't mean much to you, but let's put that into perspective. If we look at the United States household debt to GDP, we can see that we're a lot lower right now in the States, 75%. But during the 2008 financial crisis, we didn't even touch that. They didn't even touch that 100% level. And so what had happened here was they had built up a ton of debt. Their GDP wasn't growing as fast as their debt was. And then interest rates started going up prior to the 2008 financial crisis. And then once that crisis hit, they started to unwind their debt. And then you saw what that debt unwind looked like, a big slump in housing prices, a big slump in the economy. We didn't really have that bad in Canada because back then our debt to GDP was a little better than the States. We were around 80%. But now we never had that correction in debt, and our debt has only really gone up with respect to GDP. And now we are higher than the States were during the 2008 financial crisis. So now you may wonder, well, it's been so high for so long. Why hasn't this been an issue? Well, this is why it hasn't been an issue, because interest rates have been, over that period of time, interest rates have been, in general, falling. But now we have this high debt and interest rates are high. So now this isn't going to be sustainable any longer. It was manageable before because interest rates were low, but now we have high interest rates and high debt. Something's going to happen. The thing is, it really just takes time for higher interest rates to filter through into the housing market and the real economy. Take mortgages, for example. The average mortgage is renewed every 5 years or so, and interest rates have only been high for about a year. So only 20% of people have really had to renew their mortgages at higher interest rates. Now, in a year from now, in 2024, 40% of people will have renewed at higher interest rates. And 2025, 60% of people will have renewed at higher interest rates. And this actually reminds me of a Bank of Canada piece that they put out that basically said by the year 2025, 2026, people will have seen an average of 40% increase in their mortgage payment. And that's what I mean by taking time to filter through. You know, that doesn't happen immediately as interest rates go up. That happens after you've had interest rates this high and you've held them there for a while. It's over time that you see every year more people have to refinance their debt at higher interest rates, and then that's when you really see a big effect. So let's have a look at what that might look like for someone. So the average house price in Canada is $700,000, and interest rates before, or mortgage rates before, were around 2%. That would have been a monthly payment of around $2,400. Now interest rates or mortgage rates are around 6%. You can't really get a mortgage under 6% right now, at least. And that would be a mortgage payment of $3,600. So that's around a $1,200 raise in the cost of carrying your mortgage. And that's going to be what people have to pay, like raises like that, when they go to renew their mortgage. So every year that interest rates stay high, more and more people are going to see increases like that in their mortgage payments. Now, what happens to a household when that happens, when they see an increase like that? Well, some are going to be forced to sell immediately, but a lot of people are going to try to hold on and make ends meet, right? They're going to cut back their spending, their discretionary spending. They're going to do less going out to eat. They may hold off on buying a car, and they may be able to make ends meet like that for a period of time. But what happens over a couple years when that same thing happens to a bunch of people? A bunch of people are going to make those same behavioral changes and cut back. And then what we're going to see is businesses start to make less revenue in general because people aren't going out as much. They don't have as much discretionary income to spend. And then what happens if businesses see revenues drop is they're going to have to lay people off. And if you're that family who's just squeezing by making ends meet with your higher mortgage payments, and now someone gets laid off, well, now they're going to be forced to sell the house. And then it's kind of a reinforcing cycle as well, because once you get laid off, you're going to be spending even less. And then, businesses are going to make even less money and have to lay off more people, right? So really, as long as interest rates stay high, just stay in this general 5% area, we're going to see this happen more and more as more people have to, or as more people's debt roll over and more people have to pay these higher mortgage payments. So where do I see the housing market bottoming? Well, this is a cool little chart here, which shows the housing affordability in Canada. And the way they measure affordability is ownership cost as a percentage of median household income. So they basically take the average house price, figure out what it would cost to have a mortgage on that house based on, mortgage rates and that sort of thing. And then they do that as a percentage of the average household income. So you can see the aggregate is this yellow line here. The average of the aggregate is around 40%. And recently, over the pandemic, house prices went up a bunch, and then mortgage rates went up a bunch. And we've seen the housing affordability just get to a ridiculous level. The aggregate's around 60%. So that means the average family has to pay 60% of their income to sustain their mortgage, which is, a lot of money. And this chart here isn't even that recent. It goes up to January 2023. But since January, we've seen house prices creep up a little bit, and we've seen mortgage rates creep up a little bit. So this affordability number is probably even worse today. So really, I see house prices bottoming when this aggregate affordability number comes back down closer to this long-term average of 40%. And the reason being is because as long as houses are this unaffordable, people are going to have a hard time buying houses. The demand for houses is really not going to be there. Yes, people talk about immigration, 1% immigration, but this is a 20% increase in housing unaffordability. So what's bigger, 20% or 1%? 20% is bigger, right? So I think this is going to be a larger driving force on house prices than immigration. So as long as houses are this unaffordable, we're just not going to see the demand there. And the supply hasn't been there recently either. And that's why house prices have been a little bit firm. But as the things I mentioned before happen, people's debt roll over, they have to increase their payments, people may lose their jobs. As those things happen, the housing supply is going to go up, and that's going to push house prices down. And I think that's going to happen as long as interest rates stay up in this area. Interest rates falling a significant amount is really the only way I see a bottom coming into the housing market. So that's my take on the housing market for now. Stay tuned because I'll come out with videos every week, and subscribe if you like the content, and leave some comments below with what you think is going to happen with the Canadian housing market. Thanks for watching.